jumping into the Forex Beginners Bootcamp Part 8. So jumping right into this, let's actually recap. Let's recap and let's cover what we have covered in the previous sessions of the FRX Beginners Bootcamp training curriculum. So if you are on this video, in order for volume 8, day 8 to make sense to each and every single one of you guys, you would have to ensure that you have actually went through each of the previous volumes. So volume 1 was a beautiful beginner session course. We actually discussed what is FRX, what's traded in FRX, who are the participants that are playing ball in the FRX. We talked about the difference of a buy versus a sell. We introduced candles, pips, lot sizes. We discussed the pip formula on how to actually know the mathematical equation to estimate your earnings. And we also talked about spreads, starting off the trades in the negative and having to make up that small amount so that way the brokers can get their cut. In volume 2, we begin to talk about order types, sell stops, buy stops, sell limits, buy limits, market execution. We covered stop losses and take profits. We talked about basic risk to reward ratio, time frames, trading styles such as scalper, intraday, day swing, things of that nature. We talked about the different trading sessions, and we covered some very valuable session insights, such as some of the most volatile pairs, the pairs traded within the sessions, the amount of pips that each of these pairs move in these sessions, the session overlaps. Very important things to help aid you in some profitable trading. We also talked about analysis types, currency strength, correlations, and currency index. That was by far some advanced information. So I would highly suggest you return to volume 2 and you begin again at analysis types, into currency strengths, correlations, and currency indexes, as you will be using that a lot in your trade analysis. Volume 3, we began to introduce TradingView, which is your trading platform. And depending on the point in time that you are here watching this current FRX bootcamp, we might already have our brand new in-house iTrade software available, or you may still be using TradingView. But they'll have a lot of similarities in terms of usage. We also spoke about market structure, understanding the highs and the lows, and also market structure rules, how to determine if a market is in an uptrend, if it's in a downtrend. And that's how we then began to trickle into what are trends, what are dynamic trends, and how is the market reversed? What are the rules for a market reversal? In volume 4, we began to discuss price action, the introductory concept of actually trading price action. Now, one more time, this entire bootcamp is designed based on price action, which is just the concept of reading price without specializing in any particular strategies. I wanted to be able to give you guys a fresh, clean slate, understanding price in its rawest form, so that way when you are ready to master a strategy, when you are ready to find your edge inside of the market with one of our IM Mastery Academy educators, you will be well versed in the market, so that way you understand that educator's strategy. We then talked about support and resistance, pullbacks, retracements, the concept of break and retest in the market. Also, we talked about price reversal zones, supply and demand, and trading zones. These are the many different terms and terminologies that can confuse many traders, because while they are simple, they are also intricate. And we went through each and every single one of them. In volume 5, we then began to dive just a little bit deeper. We began to talk about actual candlesticks, more than the opening and the closing, but we began to talk about candlestick patterns. We talked about the anatomy of candles, the type of dojis that are present in the market, which helps you really not only understand the sentiment of the market, but provides clarity. Who's in control? Is the market up? Is the market down? As we began to dive into a lot of highly probable candlestick patterns and rules for reversals and entries, we then also dived into candlestick hacks, something that I believe is a phenomenal concept that you guys should all incorporate into your trading. We talked about candlestick zones, how to identify specific zones and the liquidity of those zones based on the candlesticks that you're seeing there. We then introduced the concept of Fibonacci's, the retracements, the extensions, clusters, confluence, and we also quickly introduced some indicators to you, or better said, the 4 type of indicators that are in the market. All right. Volume 6, as we moved on, we then began to discuss market phases, wave analysis, level analysis, and price patterns. This right here is something that has eluded traders for quite some time, as many traders are always wondering, well, when do I actually get into the market? I know support, I know resistance, I know trends, but I just don't know where the market is going. And phases, wave analysis, level analysis, or price patterns are typically incorporated into particular strategies. But when you actually look at them, this will really just help you understand, where am I at in the trend? Am I in the start of the trend, the middle of a trend? Am I at the end of a trend, which is beginning a new trend? And that will really help provide clarity for your long-term analysis, even your short term, because it's multi time frame. So volume 6, very, very powerful. Then we also introduced time analysis and time zones. Mainly my favorite, which was the fib-based trend extensions, helping you guys find not only price reversal zones, but price reversal time zones, where you can block out these points in the market that you can anticipate reversals based on time and price. Definitely go back and check that out in volume 6. Now, volume 7 was an extreme, that's the previous session that you have just completed before attending here in volume 8. Now, volume number 7 is a volume that I believe you should go over several times. And I try to cram as much vital information in there as humanly possible within an acceptable time period to help transform your mind, taking you from that young, ambitious trader ready to blow your account in every single trade to thinking on how to become a long-term investor, understanding that the future is finance. So we talked about trading disclaimer. What money should you have available to trade inside of the market? We talked about finding your edge. What's going to be your strategy? We talked about the cycle of doom, trade emotions, risk per trade, advanced risk to reward, win rate, and we even talked about equity growth. And while we did not have a slide for it, that was the trade metrics of risk per trade, risk to reward, and win rate in combination. That's going to help you really, understand how fast and how far can your account grow in terms of equity. Okay, we also talked about the profitability zone, managing some of the most important things to be able to have long-term success. We introduced a trading plan to you guys, a compound or a growth plan to you guys, and then we also discussed several trading tips that I believe will help you along your journey. So now that we are here in the final volume, this is going to be an exceptional volume because here we're really going to be diving into the market. We're really going to be bringing it all together. So here in volume 8, we just covered the recap. We're now going to go into composing a trade idea. So we're going to take a look at every single thing that we learned, and then we're going to put that together in a step-by-step fashion to help you guys see the market, break down the market, and understand when are you making some of the most important decisions that are either benefiting your trading or it's just causing it to be a total market disaster. We're going to be talking about entry insights, all right, which are going to be some additional things that we actually didn't cover in entries. And I believe this was the perfect class to cover it. We're then going to be talking about sought after markets, continuing your education. That's where I'm going to then introduce you to other phenomenal educators here in the market that you can master their strategies, not just mine. And then upon completion of this entire course, I'm going to show each and every single one of you guys how to earn your certificate of completion, where you can add your name to it, sign your dates, download it, print it, put it in your wall, put it in your room, or share it in your groups for some bragging rights, because this is a phenomenal course that you guys have absolutely went through. So I'm honored to be able to be here, to be your trading mentor during the season. And with that being said, we're going to go ahead and jump right into the continued education and information. All righty. So with that being said, let's go ahead and let's make this happen. All right. So foreign exchange in, again, volume 8, this is going to be composing a trade idea. Now, remember that this is going to be based upon pure price action. We're not going to specialize in my strategy. We're not going to specialize in a different strategy. Remember, strategies is your edge. Strategies is how you are carving out a certain part of the market that you see again and again and again and again and again, and that's what you trade. That is a strategy. What we're going to give you is composing a trade idea based upon price action. So just looking at the charts, how can you internalize the chart? How can you interpret the chart? How can you expect areas of reversals or extensions, things of that nature? And with that being said, just please remember this, okay? All right, there exists not a one-size shoe that fits all. All right, there exists not a one-size shoe fits all. It means that whatever your analysis is, there is not one specific type of analysis that's going to help you understand every single move in the market. It's just not going to happen, okay? That's why we have the strategies to carve out those areas. So you have to be well-versed. You have to understand the market. And that's what I love so much about trading. I like to understand every move as if it's my own beating heart. I like to just trade that market with my eyes closed. That's where I want you guys to be. That's where you should be if you guys want to go for the long haul. Now, moving forward, let's jump into composing a trade ideas. Okay, now, as I seen one more time, I actually did not, I did not update the text here for composing a trade idea. This is a part of the profitability zone, but I actually think it's pretty fitting. So remember this, right? A trader's profitability zone is hard to discover and even harder to enter. It's the result of incorporating the 3 major aspects, right? Which was your analysis, your emotions, and things, and your risk to reward. Okay, so that's all the things that you need to keep in mind to really enter that profitability zone. All right. Now, whenever you're going to compose a trade idea, you want to first start off with your trading plan. Now, your trading plan is it's not something that you have to wake up and look at. Your trading plan is basically your routine, understanding what you're doing and when you're doing it, how you're doing it. All right. So as an example, my trading plan is I'm waking up here in the morning. You know the exact time of the day that you're going to be ready to trade. Now, some of the main things that I'm just going to highlight here is, what are the days that you're trading? Are you trading on marketing, opening and closing days? Are you trading throughout the week? What days are you trading? Next is, depending on the day and or the time, what is the session? Like, as an example, today is Tuesday. It's a pretty good day to trade. The market opening happened Sunday. Monday, the market was beginning, to make its moves to set up for the week, setting the weekly lows, and going into tomorrow, setting the weekly, the midweek highs and things like that, right? So, okay, I like Tuesday. Tuesday's a good day. Wednesday, Thursday's a little bit better, right? But okay, I like today's Tuesday. The session, we are currently in the New York session right now. And if I'm in the New York session, then what pairs should I be trading? Well, we'll take a look at, you know what? We'll take a look at GU. Okay, we'll take a look at GU. I know we was looking at GU for quite some time. Okay, so we're in New York session. We'll take a look at GU, and since we're in the New York session, we'll also take a look at USD CAD, right? GU's arch nemesis. Okay, so there we go. Then we also make sure that we're checking for news, and we're not going to check for any news releases right now, but you want to check for news, see if there's any major, financial, fundamental news that's going to impact the market. And you can either choose to trade with the news if you know how, or you can choose to stay out the market if you don't understand the news and things of that nature, and etc. Right? So that should be all a part of your trading plan. Now, let's actually get into part one and part two for getting in the market. So before I jump into this, I want you guys to remember that there are two parts to actually composing a trade idea. Part number one is your market outlook, AKA your analysis. Your market outlook is where you are looking at the actual market, right? You're looking at the market, you are creating an analysis, you're creating a bias, you're estimating or guesstimating, do I feel like the market's going to go low, or do I feel like the market is going to go high, right? That is your market outlook. That's your analysis. Now, what I've come to learn is that the market is broke down into two pieces. Again, part one is the market outlook, and part two, which is not edited here, part two is your entry outlook, AKA your entry. You see, what has helped increase my probability as a trader is separating the two. I used to believe that an analysis wasn't an entry. So that's why when traders or educators or people, in the previous days when I was trading, they would say, hey, listen, I'm looking for the market to come up to, let's say, this price zone, 1.41600, and I'm looking to short. And in my mind, it was like, okay, well, the minute the market comes here, I'm just going to sell. And boom. And then the market's going into drawdown. It's swinging around. I really wasn't, magnifying the market down to the exact candle of entry. And that was causing me to get in the market, being at the right place at the wrong time. How many of you guys have ever got into a trade that went against you first and then went in your direction? And you was like, oof, only if I had a bigger stop loss, only if I re-entered, only if, shoulda, coulda, woulda, water under the bridge, right? So, so for me, I had to develop an entry outlook and say, okay, once I have my analysis, once I can understand the zone or the area where I want to trade, now let's jump into the entry outlook. When is this market actually ready to trade? And by dividing this into two, I was able to come out on top when it comes to trading. And I hope that I am able to do this for you guys as well. All right. Now, moving forward, let's really get into it now. So part one, market outlook. So let's start. So first off, we're going to start again using pure price action, not strategy based, just pure price action. We're going to start with the higher time frame. So we're going to come over here to the market. Let's come on over here to GBP USD. Let's go to the daily. Right now, you can go to the daily. You can go to the daily, the weekly, the monthly. Let me actually remove all these drawings. Okay. We can come to the daily, the weekly, the monthly. So here we are on the daily of GBP USD. And many traders, they just don't know what to do. They're trading support and they think that they're trading, resistance and support. Okay. So the first thing that we're going to do is we're going to come to the daily, to the higher time frame. Why? Because we really want to see, if you want to see where the market is going to go, and if you really want to trade with the market, you have to know where the market is going on a higher time frame, because the higher time frame is always going to push in the direction of it's going to be more likely to push into the direction of the higher time frame than the lower time frame. Because on the higher time frame, this is where you're going to get more important areas of liquidity. You're going to get more important areas of supply, demand, support, resistance. You're going to get more valid trend bounces. Any way that you choose to look at the market, they're going to be more valid on a higher time frame, because this is when the big banks, the hedge funds, the corporations, this is when they are trading. They're trading off a higher time frame levels, because remember, they need a lot of liquidity. They can't just come in the market and just sell the market. Remember, it takes 10,000 lots to move the market 1 pip. 10,000 lots to move the market 1 pip. So in order for the market to move 1 pip, you need basically 10,000 traders trading one standard lot size just to move the market 1 pip. So you see when the banks are coming in trading against the hedge funds and the corporations, it's just a battle of the whales. And when you're here and you're doing this, this is going to really help you trade in the proper direction of the market. So you'll know what's an actual pullback, what's a counter trend, what's the real trend, where's the real support, where's the real resistance, right? So the more relevant moves, the more accurate moves are going to be available on the higher time frame. So that's why we go there. And if the market's not clear on the daily, you go to the weekly. If it's not clear on the weekly, you go to the monthly and you keep diving down. Now here for GU, we're just going to start off on the daily. It's a good place to start. Next that we're going to do is we're going to look at our trend. Okay, so let's look at the overall trend inside of the market. Now remember, the trend is a component of two things, not just your trend line, but the actual structure of the market, right? So let's come over here. Let's get a little, we'll just use this little ball right over here, okay? Or actually, you know what we'll do? We'll use this little eye right here, okay? So we can see that the market was low right down here, okay? Let's make this black, all right? And we can see here from low, the market has, let me grab this. All right, let me just make a few copies of these. There we go. Okay, so we can see the market went low. We can see the market went high. We can see the market came low. We can see the market swung high. We can see the market swung back low. We can see the market swung high. We can see the market swung low. We can see the market swung high. And you know what we'll do? We'll do like a little replay. Let's do like a little replay. So we'll do a previous trade and then a current trade. The market went high. Then the market came low once more. And now the market's still trading inside of the zone. So we'll just leave this alone. So there we go. So taking a look at this, we can now see that the structure of the market is in fact bullish. Now what I will do is I will attempt to put a trend. Remember, trend lines are subjective. But I'm going to come to the trend and I'm going to do my absolute best to find an equal measure of price. Now, when I say equal measure of price, what do I mean? I mean that typically when you're doing a trend line, you want to do the first two hits on a trend. That will help you establish the first trend, right? You come here, 2 points of contact can give you the first trend. So you see how 1, 2, and then the market's trading on the outside of this trend here. But then if you look over here, you can see that the market is trading on the outside of the trend here. So I believe that, you know, when traders are trading trend lines, they just don't know where to put them. So for me, if you are trading the first two hits, if it's an undeveloped trend, if the market is here, then you put it here. If the market is around this area, then you put it there. But if you have a developed trending market and you have multiple points of contact, you know, you don't just put it all the way to the outside and you say, oh, I'm just going to put it all the way out here. There goes the real trend. Well, no, we don't know if that's the real trend. So I like to do an equal weighted measure, meaning that I like to look, if I'm going to put a trend line, I like to look for a point where the trend line was hit commonly the most. So if I come over here, I can see we have trend line hit here, trend line hit here, trend line there, trend line hit here, trend line hit here, trend line hit here, trend line broke out right over there, right? So as we can see over here, this is like a nice equal weighted measure. So this for me will help me understand, okay, this was more so the real trend. That's where the trend was respected the most inside of the market, okay? All right, bingo, I have a trend. Now that I see the trend, I also see that the price broke and is now trading on the outside of the trend. Now, according to market structure rules, if the market is trading on the outside of a trend, then there is an ability for the market to go down. Now, one more time, let me show you guys right over here. If you guys had used this as your point 1 and point 2 as your trend line, even though this was on the outside of the trend and it did not give a huge, massive drop, this is in fact the daily. Look at how many times this was coming to the outside of that trend and then dropping off. Can you see that? Multiple times it came to the outside of that trend and started dropping off. Okay, so very, very interesting. Remember, trends are subjective. While powerful, they are subjective. So you don't trade blindly off of trends. You just use them as points of reference. Okay, so there we go. I see my my higher time frame. I see that the market is in fact still in an uptrend. I drew out an actual trend line to just create some visual points of reference. I can see the market is in fact trading on the outside of the trend. Now, what am I going to do? Now I'm going to go to check the sequence. This is what many people miss. Now I'm going to go check the sequence of the market. Now, let me remind you one more time, right? There are, 3 type of sequences depending on what you're trading. Are you trading mathematics? Are you trading market geometry? Are you trading like institutional order flow? Are you trading, market maker levels and methods? Like, what are you trading? Now, remember, they're all one and the same. As showed you before, there's just different ways of interpreting it and analyzing it, right? So method number 1 was, let's come over here. Let's actually draw 1 and 2, right? So if you remember over here, let's actually put our paintbrush. Method number 1 was that phase of accumulation, market going into a trending market, okay, and then creating distribution, and then getting ready to come down, right? You had those 4 market phases. The other way to look at the market was you also had the levels inside of the market. So let's take a look, right? You had the levels. You had level 1. Let's copy this over here. Let's bring that down. You had level 2, right? Where the market was going to give you 3 levels, 3 pushes. Level 2, and then you had level 3, right? Where the market was either coming down or coming up, okay? And for this level, what this market was doing was this market was creating that sequence of M, right? M, A, going down push, A, going down push, W, going back up to V, right? Consolidating there, push, V, consolidating there, M. Boom. We had that WVVM over there inside of the market. Okay. And then the third type, okay, the third type of major market sequence was basically like the Elliott wave analysis, which was the 1, 2, 3, 4, 5, which was that wave analysis. Now, remember, regardless of which way that you're choosing to interpret the market, it's going to be in accordance to your strategy. Now, the reason why I've given you guys all 3 types of major market sequences to reference is because, you'll be able to see all the moves happening in the market. Okay. All right. So let's take a look over here and then let's see the market sequence. Because remember, the market sequence is going to allow us to understand where are we at. Are we in the beginning stages of the trend? Are we in the middle stages of the trend? Or are we more towards the end of the trend? That's the most important thing of the market sequence, because you know that if you're in the beginning stages of a trend at a quote unquote low in the market, you could be expecting the market to reverse and giving you a longer term uptrend. If you are somewhere in the middle of the trend, you'll be able to understand if the market's in a consolidation sideways move, and you'll be able to forecast if the market's going to keep going up. And if you're more so at the end of a trend, you're really going to be able to understand and say, okay, well, I can expect this market to turn around and give me some type of reversal. All right. So let's actually back up over here. Let's back up all that stuff, so that way it's not there. And then let's check out the sequence of the market. Well, looking at the sequence of the market, what can I see here, right? I can see that on the daily, there's a humongous W pattern happening right over there, okay? But this is way too much data to interpret. So what I'm going to do is I'm just going to basically start at the lowest point to the highest point, and I'm going to try to interpret that sequence right over here inside of the market, all right? So let me come over here, and then let's check this out. So I have a major low point, and I can do something like, I can say, okay, well, the market gave me a 1, a 2, a 3, a 4, a 5, okay? I can see in terms of wave analysis, I have a 1, 2, right? Because this was in the same zone. 3, that extension. 4, still above this zone. 5. So there we go. I have a 5 wave. This would tell me that I'm more so towards the end of a trend, and I can perhaps expect a reversal. Okay. So wave analysis is telling me I have 5 waves. If I take a look at, let's say, the levels in the market, you know, not much of a huge W all the way down here. Okay, not much of a huge W all the way down there, but this is a very, very big low. So I could also say, let me get a pathway. I could also say, okay, well, if there was a big reversal, the market gave us one big push, boom, WV, right? Moving into this whole market over here. Market gave us another big push. Oops. Market gave us another big push right over there. V, right over there. Okay, I have 2 Vs. And then now the market is going to give us another big push where we're going to look for that potential M or that potential reversal. So we would have a reversal, V, push, M. So you can see here, this market has 3 big pushes. You have one push here. You have a second huge push right over there. And then you have a third massive push right over there, right? So you have level, level, level. 1 level, 2 levels, or 1, 2, 3 levels right over there. WVVM, okay? So this is also in terms of that's also letting me know that, okay, you know, we're all the way up there. Now, if I'm looking at my market phases, again, my 4 stages of a market phases, which is accumulation, an advancing market, distribution, and a declining market. Now, remember, when we talked about that has a lot to do one way if you don't know how to identify the market phases. And again, the market phases was just based upon big accumulation, trending market, big distribution, going into a declining trending market, right? So how they did that was they would just simply take the 200, right? The 200 MA, and the 200 MA will tell you more about that. So let's say I want to jump down to, let's say the 4 hour now. Let's come down to the 4 hour, and then let's take a look, right? If we look, let me see over here. Yeah, which is this one. Okay, input 200. Let me try to come down to the 1. No, is it maybe the weekly? No. Okay, hold on. I had this thing all figured out, but I'm all jacked up now. How did I have this thing set up? WVV is definitely the 4 hours. I was looking at the shorter market. Okay, well, we're not getting, let's hide that over there. So because we're on the daily, we can't use that. So I'm gonna backtrack that statement, but what you can see here is that you can see that this is going through. It's in fact going through. So here's like a different type of concept, right? Remember, the 200 flattens out in terms of the accumulation, and then there's a rise, there goes the advancing market. And then when the market turns around, and it'll flatten out and cut through, and then there'll be the declining market, right? And then that would, help you understand the phases of the market. But again, it's a lot more than just being that simple. Okay, so just giving you guys different ways to interpret or analyze the market. So in this concept here, we'll just stick to the WVVM, and then we have the wave analysis over here. So in terms of sequences, I feel like right over here that we're more so towards the end of a market trend. So I feel like there could potentially be a reversal happening over here in the market. Okay, so if that's how we feel in terms of market sequence, okay, do I feel like we're more so towards the end of a market? What am I then going to do? Let's come back over here, and now we want to check out the zones. What zones are we trading in? Because remember, once you determined the sequence, right, of the market, beginning, middle, or end, or any stage of the trend, okay, you now have zones. Now we have to start looking at the zones of that market because you're going to be trading off those zones. So now we're going to look at zones. So let's come over here and let's take a look at some zones. So what I'm going to do to look at some zones is we're going to get our horizontal ray, and then we're going to begin to highlight some important key areas, okay? So we have the wick high, and then we have the wick low right over here. So those are some zones, right? We also have the body of the candles right over here. That's a good zone. And we also have the body right over here, okay? And again, remember, as I'm creating these zones, these are your quote unquote support and resistance, or your supply and demand zone. Remember, these are those structure zones that you want to pay attention to inside of the market. Now, again, if you don't know what to do, you can do the high of the zone, which is the wick, or you can do the low of the zone, which is the body, right? So if you want more of a range, how high can I potentially, in a perfect world, see that market come up to? You have the wick. If you want to see something more specific, you can try to check out the body. Now, remember, nothing is going to be absolute or perfect. It's all going to be depending on how you interpret the trade idea for the market. Okay. Now, another thing that I like to do is that I like to do the equal weighted area. So if I'm going to create a zone, let's say I do the wick, I like to see wick to wick. If I do the body, I like to see body to body. You see that? You see how the body of that candle and that body of that candle is right there? That says a lot. If I come over here, I did wick to wick down here, and this came across, it came pretty flush with almost that body. And then I ended up creating that other one from the body. So I did that bottom wick, and then I did this body over here, giving me a little bit of a range. I bring that across. I see that that's at the top of those wicks over there. That's giving me a pretty strong confirmation. If I want to see the equilibrium of this zone, I could do something like high to low over here, right? I can try to put out maybe like a 50% of that zone to see how that zone is feeling. I can do a 618 of that zone, right? I can do a 38.2 of that zone, right? I can use all my Fibonacci levels if I want as different zones inside of the market. Okay, not that I'm going to right now, but I can use each and every single one of these as zones to determine, okay, well, what are those key areas of support and resistance that, the market could potentially turn around at. Okay, but for now, I'm just going to delete these other zones. Okay, for now, I'm going to delete those other zones. I'm just going to leave my higher low zones. I'm also going to check some previous price action, right? You want to check previous price action. You want to make sure that those zones are valid. Remember, if these zones are truly valid, as you look back, these zones will also hold on other previous levels. So we can see this low zone. Look, we had a nice wick over here. We had the market wick that zone over there. Look at how this previous zone, we had some big reversals inside of those zones right over there, right? And now we're going all the way back. But, from 2018 to here, we can see that these are some pretty good zones inside of the market. Say, okay, I like these zones. I like these zones. I could potentially trade off of these zones right over here, okay? Now let's come back to the market. And again, we have our high, we have our low. So don't forget that this entire area is your trading zone. So you essentially found your area of supply right over here, and you've essentially found your area of demand right down there, okay? Now, from there, what I'm gonna do is I'm now gonna check my market structure, okay? I'm now gonna check the market structure. So I found my zones. I'm now gonna look for market structure. So, I'm still here on the daily. I can drop down to the 4-hour now, okay? Now I'm here on the 4-hour. And now here on the 4-hour, I want to check the market structure. Now, remember, the market structure is going to help me again understand the current trend of the market, right? So we can see that on a larger time frame, the market is essentially still uptrending, high, low, potentially making new highs. But on a higher time frame, we're right here in that zone. That's valid information you have to hold in your mind, because you're going to start to create, these complex analysis to aid you in your decision making. Now I drop down, let's say I'm on the 4-hour. I'm now going to look at the market structure. I'm going to say, okay, well, what is this market structure now telling me? Okay, what is the market structure now telling me? So if we look over here, let's take a look at this market structure. So we can see here now this market structure, right? Let's change the color of this little eyeball over here to, let's say, because this is the current direction of the market, let's turn it to like a blue, okay? So let's look at the current structure of the market. Give me 1 second over here. Okay, let's look at the current structure of the market. So we have high, we have the market came to an equal low right over here. That's what we call a double bottom, right? That there could have been a whole trading opportunity on its own. From here, the market pushed high. From here, the market pushed back low. From here, the market pushed back high. From here, the market pushed back low. And from here, the market is back up at this high point, okay? Now, why is this so important? This is important because now that, again, I'm trading in the zone, what happens when you come to areas of supply inside of the market, right? Big areas of supply. These are potential areas to sell. And when you come down here to the demand zone, these are, let's just bring this all the way out so it's not bothering us. These are potential areas that you want to look to buy up in the market. 1 second, let me just grab that. Let's highlight that. Okay. So potential areas to buy, potential areas to sell. But remember, these are decision-making zones. Because if the market says, you know what, I'm going to break and retest and then go up, there is a possibility that this market can continue going up. But remember, because let's write this down here, larger time frame sequence, suggests end of trend, okay? So now you are already starting to develop a type of analysis. Okay, this looks like it's at the end. So that means I'm going to look at this more as a resistance instead of a, level. So this is more of a resistance that I'm going to be looking at right over here. So I'm already starting to develop the mindset. Okay, I think that the market can drop from this area. So now again, lower time frame. Now I need to look at the market structure on the lower time frame and say, okay, what is this market structure telling me? Currently right here, I can still see that the market is in an uptrend. And hey, you know what? Maybe I want to perform another sequence. I can see a 1, a 2, a 3, a 4, a 5. Ooh, that's important. Why is that important? Because, again, the market is making another sequence. There was the supply, the demand, there goes the supply. So this is basically your support. That's your resistance. So the market is making a trend up. Well, where is the market in terms of the trend going back up here? I seen a 5 wave going up. I like that. I see a huge W. Let me see over here. Boom, I see, there goes a W, push, right? We got the big V over here in the market, push. We got the big V in the market, push. And look, now we can have another potential M happening right over here in the market. So now we have another completed sequence. We have another completed sequence in the market. So now this is suggesting to me, okay, larger time frame sequence suggests end of trend. Okay, let's drop this down more. Larger time frame suggests end of sequence, right? Right? We have a lower time frame. I mean, it's the 4 hour, so technically it's not lower. We have a lower time frame sequence suggesting the end of a trend. So now I'm at the end of 2 trends. That's already building on my confidence, saying, hey, listen, I think this market's going to potentially start coming down. Okay. I believe this market's going to start coming down. Now let's come over here. Okay. So now that you've identified the market structure, we see that the market structure is still in fact up. Okay. Market made a high. Market made a low right over there. The market is holding. There we go. Now what am I going to do? Now I'm going to determine what are my points of interest. What are my POIs, right? POI is points of interest. Those are the points in the market that interest you. Where do I think that this market can start reacting? I understand it's the end of a sequence on a larger time frame. I can see it's a potential end of a sequence on a lower time frame. I can see that we're now we're now at this area of supply right over here, which is my resistance. Let me actually mark up these. Let's actually label that for you guys, right? So we're looking at also at some zones, some supply zones right over here, right? And then we have a demand zone. We have a demand zone. Remember, supply and demand are the bank's support and resistance levels. Anything in between here, that's more so support and resistance. The major swings of the supply and demand. So anyway, market structure, high, low, still holding the low, right? And now we're just trading within this zone. So now we're going to look for our points of interest. So the points of interest is where we're now saying, okay, well, where is it that I want to potentially enter in this market, or what am I looking for? So now I'm going to get this. Now what I'm going to do is I'm going to just mark up, a high over here. And I say, okay, this is the high of this trading zone. And then I'm going to mark up the low and say, okay, here goes the low of my trading zone right over here. Okay. There goes the low of my trading zone right over there. We'll just make those dark. Okay. So there goes my high. There goes my low right over here. We'll make those dark. Okay. There goes my high. There goes my low. These are my points of interest. Why are those my points of interest? These are my points of interest because these are going to be the areas that I'm looking for the market to either break, or I'm looking to make basically a decision based off of these zones and the analysis that I'm already building. So now once you determine your POI, your points of interest, where you want to see the market react at or turn around at or break and retest at, whatever the case is, this is where you now have to create a forecast. Okay. The forecast is basically where you are now going to make an educated guess, an educated decision based on where do you think the market is going to go. So now my forecast would be to say, again, if the higher time frame sequence suggests an end of a trend, if the lower time frame sequence suggests an end of a trend, if I'm at a supply zone, okay, and I'm here, my forecast would say, okay, well, I would like to see the market, bounce out this area, give me a drop here, I would like to see the market break this low right over here. And then I would like to see the market, eventually pull back into this area and then continue, to go down to some type of, area, boom, let's say boom, boom over here, right? Okay. So this would be my forecast. This is what I believe that the market will do. And now that you have a forecast, in the market, you're now going to begin to look for your entries. Now, before we go to the entry outlook, okay, let's also talk about some other important concepts that many traders don't incorporate because it does require more work. However, it does increase the probability of your trade. And again, remember, in the beginning, this will not be second nature to you. If you guys have just went through the beginner's boot camp, chances are that you are so brand new to trading and you are already, right now, I want you guys to understand this. If you're in your first week, your first month, your first year of trading, okay, you are getting the eyes and the experience of traders who are 10 years plus in the market. I am almost 10 years deep trading within the financial markets. And I've also am learning and have learned from people like our CEO who have been trading in the market for 30 plus years. So we're talking about a polished person who took everything that they knew, became polished, and now I'm taking everything that I know and I'm giving it to you to polish you. So you are really, really looking at the market for what it is. So if this is going over your head, please remember, do not get overwhelmed. Don't get overwhelmed. Just rewatch this video again and again and again and again, because we are giving you the golden nuggets. We're not giving you the YouTube BS. We're not giving you the Google BS. We're giving you the real raw market, the real decision-making process, the understanding of it. So if you're brand new and this is like, whoa, to you, guys, trust me, don't even worry about it. Take it step by step by step. As you continue to do this again and again and again and again, remember, practice makes permanent, right? So with that permanence of information that's going to be embedded into your mind, while this is going to be difficult at first, when you do it enough, remember, the only difference between the student and the master is that the master has failed more times than the student ever tried. I'm going to repeat that. The difference between me and you is that I have failed more times than you have ever tried. And this is why I'm so good at this, because it's routine. It's boring to me. I can do this with my eyes closed. So I want to be able to get you there. Okay, so in the beginning, it's going to feel like a lot of work. You're not going to want to check the correlations and the index and the and everything over here, because you're like, oh, it's going to take so much work. I just want to get into the market. But never forget the story of the lion in volume 7. You are a lion, and when you do this enough, this right here takes me every bit of like 2 to 3 minutes to look at. With my eyes closed, I'm like, boom, 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 boom. The whole analysis is in my mind. And now when I give you an entry and analysis, I'm just highlighting what's important, giving you the forecast. I'm like, okay, this is the entry. That's all I'm doing. That's all the educators do, because we know it. This right here, this is the decision-making process that's going on in our mind. This is what we see with our eyes closed. Remember that, okay? So now that you have your forecast and your POIs, where you're looking for the market to enter, and before you go to the entry, I would say to do your index or your currency correlations. Okay, so since we're in the New York session and we're trading GBP USD, the arch nemesis of GU is UJ. So let's go take a look at UJ. And remember, the correlation of UJ, remember, some pairs are going to move the same, which was available to you guys in volume 2. All the pairs that move similar are in volume 2, and the pairs that move opposite are also in volume 2. Now, GU and UJ have a tendency to move opposite, right? Because one is the base and one is the quote, which is the USD, but they're both a part of the New York session. So if we are expecting GU to come down, then that means that we should be at a point of expecting USD JPY to go up. Does that make sense? So that would give us a really, really big confirmation. Now, there's two ways to do this. We could just come right over to the chart, or you could also do something known as compare, right? And compare is not something that I went over with you guys, but it's something that you guys can do, right? You can compare the currencies. So you see that yellow line, that orange line? That orange line is the USD JPY market. And I can choose to change it from line. I can actually make it candles where it looks like candles. I can do area right over there. I can do, a baseline, which I don't really like. The baseline, I can do bar. You can do all this. But for me, candles is fun to look at. For me, it's, it just gets a little too intense. So I like to keep it as the line. And the thing is that when you move this around, you'll see that the line is always moving around, right? So one thing that I've learned about using the compare tool, when I'm using the line, if I want to see something going the same way or seeing something going the opposite way, okay, is, I'm so sorry. That's my throat. When I see something doing the same, pardon me, when I'm doing the comparison on the line chart there we go. I like to zoom in to a point, right? I take off the auto because that auto has everything always messed up, right? So I like to come over here and then I like to try to find the points where everything is touching perfectly, right? I can't do it over here because all that markups is over here. But let's say I come over here, right? I like to do it where I kind of look for the points to be perfect. Let me come over here. This thing's annoying me right now. Why is it doing that? Is it because it's on percentage? No, it has to be on percentage. Okay. Okay. Where? Oh, come on. I do this all the time. Now this thing wants to act crazy. Okay. So I like to do it like this, where there are, you'll see when it crosses over, you'll see that there's a huge cross. Or when the line chart dips here and pulls up, the actual bar chart dips there and pulls back. And you'll see the cross. You'll see UJ pulling back, you'll see GU pulling back. Like as an example, you see the cross and it went up and pulled back to the previous level of support right over there and then go up, bam, you'll say it's going up. And then I'll do the same thing on UJ and I'll say, okay, well, UJ, it came down, boom, it came up to a previous level of support, retested, and now it's going to go down. So when you get a little bit more advanced, you can do the comparison and then just do it just to train your eyes and see how you feel about that, okay? But mainly what you're going to do is when I come over here, let's do it like this, okay? Now, when I come over here, let's look at the time and the dates. So let's do the real way. Let's do the time and the date. So over here, this is May 21st. That's May 31st of 2021 at about 1 p.m. So May 31st, 2021, we are expecting GU to go down. So let's come over to USD CAD. Okay. And now we're going to look at May 31st. We're going to try to come to May 31st. Boom, May 31st at 1 p.m. right over there. Let's do a replay. Let's get rid of this. Boom. There we go. May 31st. So now take a look because this is what happens. Okay. Let me also remove these drawing shoes from USD CAD. Okay. So there we are. I am on May 31st of 2021. And now on May 31st of 2021 for GBP USD, okay, I got to put that replay back. Now I got to keep doing this. Give me 1 second. Now on May 31st, I'm expecting GU to come down, okay? And because UJ is the opposite, I have to expect UJ to come up on May 31st. I mean, USD CAD. I'm so sorry. USD CAD, not USD JPY. USD CAD. I keep saying USD JPY. USD CAD. I'm so sorry. USD CAD. All right, let's come back to May 31st, and then let's run up an analysis on this really quick. So let's go back to May 31st, right there, 1 p.m., 1300. There we go, May 31st, 1300. Bam. Let's do the replay. Let's come over here. Let's delete it. All right, there we go, May 31st. Now I'm going to come up to the daily. Now, again, why is this so important to do the, not so much that it is important, and not that you have to, but you should. The reason why I also like to do currency correlations is not only will it strengthen my idea on, let's say, GU, if I want to short GU, but it can also put me in a position to also enter the market on USD CAD. So if I can find a buy analysis that makes sense on USD CAD and find the sell analysis on GBP USD at the same exact time, I can now enter two markets and expect one clear move. I can expect GU to drop and I can expect USD CAD to go up. And that equates to another highly probable trading opportunity for you in the market. So, all right, USD CAD, we're over here. Let's say we're on the daily. Let's try to draw out some zones. Let's see if we have some good short zones all the way down there on USD CAD. Now, wow, look at this. Look at how USD CAD, this is a lot of markets. So let's come over to the weekly. Okay, so let's take a look at USD CAD. So USD CAD, May 31st is all the way down here at this low. And as we look back in time, what do we see right over here? Look at that beautiful wick. Look at that beautiful wick. Look at these price zones. Let's make a nice price zone over here, right? You have body, you have wick. It didn't actually come all the way down there, but we'll just leave that marked up. Look at that beautiful, beautiful, beautiful area on the weekly. Now, what is this on the weekly? This is now a demand area. This is most definitely a demand area on the weekly. It just makes absolute perfect sense right over here. Okay. Now, okay, there we go. I got that. Do I want to do market phases? Do I want to do all those other things? Yes, I can do that. And I would have to do the opposite. So let's come over here. Let's take a look just for the sake of it, because we're going to go in today. Okay. Let's say I'm over here and I say, okay, what do I want to see over here? So over here, I should be expected to see some type of wave analysis. Now, this is quite a ridiculous push in the market. And again, if you look at this recent year compared to the rest of the entire market of Forex, you see how everything is nice and beautiful, trending. It's just way easier to read. And then you look at the current present days in the market. You know why this stuff looks so crazy? Because COVID hit, the entire world being upset that, President Trump had went into office. So the market the last year, 2 years, 3, 4 years have been very, very, very crazy due to all the, political and geopolitical changes that have been happening. So sometimes you'll see the market look like this because the market was forced into new directions. But there will still be some sense that you can make of it, or sense that you could attempt to make of it. So again, just look for your levels. So let's say you have your level, you have a huge push, you have another huge level here, you have a huge push, and then you're going to be looking at another potential, big level right over here. Okay. Oops. Push that over here. And you have another huge level right over there. So now you have levels with 3 huge pushes. There you go. You have 1 push, 2 push, 3 push, all the way down here to the low. If you want to do your wave analysis, you could potentially maybe look for a 1, a 2, a 3, maybe a 4, an extended wave all the way down there, 5 in terms of wave analysis. Remember, there are lots of different ways to interpret this. And if you don't want to do it on the daily, you can come down to the 4 hour. Let's say we come to the 4 hour and you want to see where the market reversed last, right? So you see this was the low point. The market pushed back up over here. And now you can say, okay, well, I want to look from here to here, right? I want to look from here to here. Okay, market went up. We had a M, boom. There we go. You have that M. Market pushed down. You have that V. Market pushed down. You have that V. And then market came down. And now you're getting that W right over there with your zones and your levels. You see that? Right over there. So there are a lot of different ways that you can interpret this market. All right. But anyway, for the sake of time, I don't want to go into a huge, massive analysis on USD CAD after we just did it on GBP USD. So, okay, there we go. We are at the end. We've seen an M, a V, a V, a V, a W. We're at the end of that stage. We're at a massive area of demand. So we can expect this market from here, let me get rid of that, to go bullish. And now that is giving us a beautiful currency correlation. Now, in addition to that, we could also take a look at the index. So let's take a look at the index. Let's do that. I told you we're going in today. So GBP USD, we were looking for GBP USD to short on May 31st. Now we're going to come to the DXY. Let's say we want to look at the index, okay, for the DXY from May 31st. So let's take a look at May 31st. Let's come back to the daily. Let's look for May 31st on the DXY. Okay, we're going to draw a vertical line. And we're going to come to May, June, May 31st, right there. Bang. There goes May 31st. Let's do a replay one more time. Here we are, May 31st. And here we are on the DXY. Now, again, we talked about trading the indexes. And we talked about all the indexes, the Euro index, the Yen index, the dollar index, all these different indexes, right? Why is the index so powerful? Though the index is the futures. It's considered futures in the market. So this is going to tell you the overall strength of the US dollar, right? So this will also help you determine what's going to happen with GBP USD and what's going to happen with USD CAD. Why? Because again, we talked about the strength. So if we do GBP USD and then we do USD CAD, all right, let's take a look at this. Okay, and then we take a look. So here goes the two pairs. Let's mark this up. Let's mark that up, and let's mark that up. Okay, so remember, if the dollar is gaining strength, right? If the dollar is anticipated to go up, if the dollar is anticipated to go up, remember, this is the base and this is the quote, right? So if the quote gets stronger than the base, if GBP, if DXY goes up, then that means that USD is supposed to go down, okay? Now here we go. We have the quote and we have the base. If the base is stronger than the quote, then that means that this pair should be going up. Remember, we talked about the index. We talked about the currency correlations. This was all in volume 2. This will aid you in understanding where is the market going. Will you always do this? No. But should you do this? Yes. Okay? So there we go. So if we can analyze this DXY, and as we can see here on this DXY, what do we have over here? Again, look at the market phases. I really hope that this is making sense to you guys over here, okay? Because it's just the same exact thing. Look, you have a bigger M over here. Okay, you have the market going down, giving you a V. Market going, it's MAAW. So you have the market giving you A. You have the market giving you A, and then boom, the market giving you a potential W to swing around right over there, right? Look, you see the A, boom, M, it's MAAW, WVVM. I know I mess up sometimes. Sorry, it's my dyslexia. Okay, boom, there we go. Look at it right there. It looks like we are at the end of a particular thing. If you want to do a wave sequence, you could do a wave sequence, right? You can do a 1, a 2, 3, 4, 5. Remember, there's always an extended wave. Well, we guys didn't teach you that, but there's always one extended wave inside the wave. Either wave 2 or wave 5 is always an extended wave, right? So anyway, regardless, boom, now we have a 5-wave sequence coming down. We have the 3 levels. We have the pushes. Push 1, push 2, push 3. Do you see the pushes? 1 push, 2 push, 3 push. Guys, am I making sense to anyone over here? Now, boom. So now we see the DXY and the DXY here, the market sequence of the DXY, the levels of the DXY right over here are also telling us, hey, this can be bullish right over there. So now I'm going to delete all this. But now, ladies and gentlemen, now we have a stronger forecast. We have a stronger forecast. Let's come back to GBP USD, right? Let's go back to the replay. Okay. Okay. Here we go. Let's come back down to the 4-hour. Let's start all the way where we was. Okay. All right. So now we have an even stronger, we have a strengthened forecast in the market. Why? Because the correlation makes sense. So now we don't have one trade idea, we have 2. In addition to that, the index is also in our favor. And if you trade futures, you can go ahead and trade the DXY if you want. But this index is now corroborating with GBP USD and USD CAD. The correlations are making sense. The index is making sense. I now have a strengthened, I just had an outlook before. Now I have a strengthened outlook. I am much more secure in my decision-making in the future. And why is that so important? Because now when it comes to entries, you want to make sure that you boil it down all the way to the candle that you're going to need to enter. All right. So if that makes sense, go ahead, you guys. You guys can type a yes for me inside of that chat box if this is making sense for you guys. All right. Now there we go. All right. So now I have my POIs. I have my points of interest. Okay. I have my forecast now. Okay. I have my forecast now where I feel like GBP can go ahead and come. Let's bring this back over here. Okay, I have my whole entire trading zone. I have everything that I need. And now it's time to jump into our entry outlook. Now, give me 1 second. Now we're going to get ready for our entry outlook. Now, the entry outlook, this is where we're going to boil down the candle to the entry. Where exactly are we going to enter? So step 1, whenever we do this for the entry outlook, step 1 is that we like to reduce the time frame. So now we're going to go from the 4-hour, we're going to drop this down to the 1 hour. Right? Entries are good on the 1 hour, on the 15-minute, and on the 5-minute if you are successfully, peering through the market, which means like going from higher time frame to lower, because again, you now know where the market's going to go. So entering on the 5-minute makes much more sense because we already feel like the market is going to be going down. Okay. So boom. So there we go. All right. So we're going to reduce the time frame. So now I'm going to come down to the 1 hour. Now, the second thing that I'm going to do is I'm now going to determine my entry types. Remember my entry type. There are 2 different type of entries, right? You have entry type, which is your E1, E2, E3. And then you have different type of entries, which is early confirmation momentum. And we'll get into that in a moment. So let's determine now, and this has to really do with the strategy that you're trading. But let's keep price action in mind. So now we're going to determine the entry type. Now, what were the entry types? E1, E2, and E3. E1 was, remember, the pullback to the equal high. Remember, E1 was a pullback to an equal high or an equal low. E2 entry is the breakouts of a high or the breakouts of a low. E3 is the retest of the previous high or the previous low. So now you have to determine where do you want to enter. You have your points of interest. Now, where do you want to enter? So let's come over here and then say this. Okay, so if I'm going to do an E1 entry, right, this is all going to be depending on your risk appetite, your personality, your strategy. Again, I'm just showing you price action. So an E1 entry would typically be right up here. This would be an E1 entry right up here because you are coming right back to those high points inside of the market. So you're going to basically look for the market to come right up in this zone, right here somewhere. Let me give you, let's put a star, okay? This right here is going to be your very, very first position of entry. Thank you. This is going to be your very, very first position of entry right over here. Okay, so here goes your E1 entry point right over there. So is this valid point to enter? Yes, it is, depending on your analysis. Now, your E2 is your breakout. E2 is the breakout. So if you don't want to enter up there and you're saying, well, listen, the market structure is still bullish. The market structure is not yet bearish. The market trend did not yet turn around. Like, let's take a look. Remember that this reduced trend is still up. Even though it's at the end of that trend, it's still bullish. I don't know if I want to sell this. I want to get a confirmation. I want to make sure that the market breaks that previous low following those market structure rules to make sure that that market's going to go down. All right, no big deal. Where's your E2? All right, E2 traders are going to say, okay, I want to see this market come right down here. I need to see the market break this low right down here. And what is the lowest low in this market? Here goes the lowest low right down there. Where's the body of that candle? That candle is about 1.4100. All right. So you're at 1.4100. Break and close, right? So that's what you're looking for right now. An E2, the E2 trader, their entry point, the E2 trader, their entry point is going to be the break and the close of that 4,100 area, right? Because that's where the body closed, the wick went there. So you want the next body to break and close outside past this level. And then you're going to say, okay, well, that's where I want to enter. I now want to get into that E2. Now, the E3 entry point is the retest. Remember, this is all following the market structure rules, right? This is all following the market structure rules. So before we get to E3, let's check out E1 and then let's check out E2. Now, all right, no, hold on, because I have to go to validate the POI. So E3 would be the retest. So even though the market did not drop yet, we cannot successfully find the E3, but the E3 entry point is going to be the retest of the breakout, right? The E3 entry point is going to be the retest of the breakout, okay? Okay, and the E3 is going to be the potential retest. Now that you've determined your 3 points of entry, am I going to enter E1 equal high, E2 breakout, E3 retest? If I'm going to enter one of these, now what you need to do is now you need to validate your POI. You need to validate that point of interest. You need to validate that entry by building up confluence on that particular trade. Now remember, building up confluence is basically, your entire, and this kind of goes together, right? So validating your POI and determining your entry type. So before I get to confluence, let's determine the entry type. There are, 3 type of entry traders. You have an early, right? So this should actually be reversed. You have an early entry, you have a confirmation entry, and then you have what's known as a momentum entry. Early, confirmation, and momentum. Those are basically meaning that when you're at these points, E1, E2, E3, again, E1, E2, E3, when you are at these points, you're either going to trade it early, like to the wick. You're going to wait for more confirmation, meaning that, as an example, let's go to the E1. E1, an E1 early entry would mean that you want to, once you've did it, you're going to literally confirm your wicks. You're going to confirm your wicks right over there. Boom. Right over there, as close as you can, as high as you can. You're going to say, okay, right here is exactly, I'm going to just, you're not waiting for nothing else. You're just waiting for the market to hit that level, hit that price, and then you're going to expect that market to just drop like a tank right over there. Okay, at the E1 entry point, that's an early entry type. The second is the confirmation entry. The confirmation entry is when the market has moved just a little bit more. Meaning, and then when we start playing out the market, you're going to see, but I want to talk about this first before you see the market playing in real time. So that way, you know, you could really like see what's happening. Okay. So a confirmation trade means that once the market starts moving in your direction, you're going to wait for some sets of confirmation. Like you might wait for the crossover or your EMA. You might wait for the break, you know, in a previous level, or, you know, whatever the case is, right? You're looking for more like confirmation to get in. So it's going to hit, it's going to reject. So, all right, so there we go. So you'll wait for like a candlestick pattern over there, and then the cross of like a 4 EMA, or the cross of a 4 McGinley, or, you know, like a red bar or something, right? You'll look for a confirmation and then jump in. So you'll get in a few candles late, right? I'm a confirmation trader. And then you have momentum based trading. A momentum based trader is the person that says, okay, like if you're looking at this over here, the early trader is going to get in at that wick right over there. The confirmation trader is going to get in once the market turns over, right? Nice engulfing candlestick pattern or some reversal candlestick pattern crossing over the McGinley, something like that. Then the momentum trader is going to be the last trader to enter. The momentum trader waits for the previous structure to be broken. So that means that it hit the level, the market turned around, and then they're waiting for the rest of the sellers to hop in the market, and then they're going to wait for it to break that previous low, that very last low that market made. And then they're going to want to get into that momentum that jumps down. Like the E2 is like a momentum based trade where you're waiting for the low of the market to break. Okay. So you're a confirmation trader, or you're a momentum, you're an early entry trader, you're a confirmation entry trader, or you're a momentum based entry trader. Now, again, now that you understand E1, E2, E3, you understand if you're early confirmation or momentum, please remember that you're validating your POI, which is setting up your confluence. That is going to be based on your strategy, okay? That's going to be based on your strategy. Every strategy has a different set of rules. So if you have not yet mastered a strategy in IM Academy, when you begin to trade with me or one of the other master educators, they're going to give you a set of rules when they train you on their strategy. And you only enter the market when those set of rules and those conditions have been met. That's their confluence. That's their confirmations to enter in the market. So when I say validate your POI, your confluence, if you're trading a strategy, just remember that that's going to be your set of confirmations. So for us, because this is price action trading, we're just going to go ahead and validate confluence, meaning that you have no strategy, you're just trading price action. We're going to go ahead and validate the confluence in the market. So what am I going to look for over here? Okay, so confluence for me is going to be this, multiple different things. So going back to, let's say, a 4-hour time frame, I want to come over here and I want to check for a couple of different things. First thing that I want to check for is I want to check if the previous zone was a valid zone, right? I want to see certain candlestick patterns, and I want to see that this was in fact like a very good level. So what I can see here is that we had a nice consolidation level and we had a huge break breakaway candle. We had this huge shift candle happening over here, clearing those lows, jumping all the way down. That's telling me that the market does not want to be here. I can also see here that we do have some bearish engulfing candlesticks over here, also showing me, and we have other very long candlesticks here, showing me that there's a lot of volatility in this market. We have long candlestick there. We have a long candlestick here, right? We have the bearish engulfing here. We have a huge wick right up here. That's that huge wick. What is this telling me? Huge wick is telling me that the market is exhausted. This is the point of exhaustion up here. The buyers couldn't hold. The huge candlesticks are telling me that there's a lot of volatility, a lot of volume in the market, means that the banks don't want it to be there. So they're pushing they're pushing the market fast out of that zone. So I know that the market does not want to stay in this zone. I see candlestick patterns, bearish engulfing candlestick patterns. That's, again, this is candlestick confirmation zones. We covered this in one of the previous lessons. This right here is telling me that the sellers are taking control. It's very evident that the sellers on a retail level are also taking control of the market. So already I like this supply zone over here. Now I'm going to come back over here. Okay. I'm also at the end of the trend, right? The end of the trend is amazing. Now let's see, what else am I looking for over here? Okay. Over here, there's not much confirmations. But over here, what do I see? I do see a huge doji reversal candle. I see another big bearish engulfing candle happening right over here. Okay, so I like this. Okay, I like this good E1 entry point happening right over here. Okay, so now let's say we want to get into the market. So let's put this back up, and then you enter by the market anywhere within that price zone right over there. This price zone, oops, let's come back to the 1 hour. Okay, there we go. Back on the 1 hour, there we go. That's a little bit better. Sorry, guys, I didn't realize I was on the 4 hour. Okay, we come over here, we look at the top of the zone. Bearish engulfing candle, right? Almost looking like an inverted hammer over here. Okay, you have nice candles over here, almost looking like a railroad. So we're looking at a lot of price action, happening. Good wicks here, good wicks there, strong wicks over there, good wicks right over there. No imbalances in the candles or anything like that over here. But regardless, this seems like a pretty good area to have your first entry. So let's see if you do the first entry, right? And then before I do that, just remember, this is where you now set up your trade. You drop down to the lower time frame and you do multiple time frame entry outlook. So I get a little tongue twisted because it's a lot to explain at one time. So now that you've determined your entry, you validated your POI, you've done everything that you need to do, which I'm about to go into, so that way we can show you the market trading. Okay. Now, once that's all set up, you're now going to set up your trade idea. So basically your trade idea is now saying, okay, well, I feel like the market, I feel like I can enter right over here. So I'm going to go ahead. I'm going to look to, enter the market right over here. And I'm now going to be willing to risk, the last wick was over there about 15 pips. I'm going to put it up to about 20. So I'm going to be willing to risk about 20 pips on this trade. And I want to get, let's say 40 pips, or let's say 60 pips inside of the market. Okay. A good example to do is, let's say we'll do a 1 to 2, 1 to 40, 1 to 45, like coming around those lows. So let's say we want to do a 1 to 2. So I'm going to say, okay, I'm willing to risk 20 pips to make 40 pips on this trade. And again, if my risk per trade is, let's say I'm doing a 3% risk. If I'm doing a 3% risk per trade, this is where your trade management comes in. I'm looking to get a 6% gain on this particular trade. This is where you now use your compound plan and sheet to determine, well, what is your entry size? What's this? What's that? So let me give you an example here, just so you guys can do this in real time. So let's go to the compound plan. Okay. So at this point, you guys are using the compound plan, right? You're going to come over here. You're doing a risk percent is 3%. Your pip plan is 20. Let's come over to the compound plan. And again, your starting balance was, let's say your balance right now was $1,000. Okay, boom, $1,000. You come over to the compound plan. You have $1,000 in that account. Let me zoom out over here. And then let's say you've been trading that for a little while now, and then your actual balance is now $1,056. Boom, we're gonna update it. Okay, so there we are. You're at $1,056 right over here. You're risking 3% per trade. You have a 20 pip stop loss over here, right? So that means that you're going to be risking $31.68, and your lot size is going to be a 0.16. Okay, your lot size is going to be a 0.16. So that means that right here, okay, your lot size is going to be a 0.16. Okay, your risk is going to equal a total of $31.68. $31.68. And your reward, if you hit the full take profit, is going to be double that. So you're looking at about 62, 63. You're looking at about 63.24, right? And you're getting about $63.24. Okay, so that's what you're expected to risk. That's what you're expected to gain. All right, there we go. Boom, we enter in the trade. All right, so you set up, you can now even come down to a lower time frame and you can continue to validate your entry. So let's see what happens over here. Okay, you go forward. Okay, there we go. You are activated in the trade. Boom, stop loss hits. What do? Are you getting in or are you getting out? What are you now doing here? What are you now going to do, guys? What are you now going to do? Again, you as an entry trader, you wanted to get in over here. You wanted to confirm that zone. What about the wick over here on this zone? You just lost your money. Do you stay out the trade? Do you stay out the trade? What do you now do? Now, you pull up your big boy pants and you determine, do I get back into this market? Should I get back into this market? Well, if I get back in, I'm going to want to get back in at this high point. Because you know what? If I lost once, am I going to lose second? Well, let's see. That's what you guys do. Boom, you end the market. And boom, this one ended up hitting your take profit right over there. Why? What was the difference between this zone and what was the difference between that zone? You want to know the difference? It was the liquidity. It was this wick right over here. You see that wick? How that wick came all the way to the top? So you have to remember that, wicks matter, okay? Wick lives matter. That's why there is a true range and there's an average range. The true range is the candle, the true range is the candle, the average range is going all the way up to the wick right over there. Now look at the difference. Now again, remember, with proper risk to reward, I'm gonna mention this to you guys. With proper risk to reward, I want you guys to think about this. You jumped in the first trade, you just lost $32. Okay, you entered this second trade with the same exact risk, and now you made $63. So you won one trade, you lost two trades, but guess what the magic is? Your overall profit is still 31.68. Guys, you still made profits. You still made a profit. Why? Because of your risk to reward, the trading metrics. So I want you guys to remember that, okay? When we talked about the previous class, when we went into the previous class, volume 7, okay, we talked about trade emotions. If you're losing a trade, to manage those emotions, the risk per trade, your risk to reward, and what is the win rate on your strategy. We're not even trading a strategy. We're just trading price action. And remember, a lot of people lose a price action because they're over leveraging, one, and two, they don't have an edge. They're just trading price action. Remember, a strategy is your edge. A strategy is a very particular scenario that you're looking to happen again and again and again and again. So you're not just trading every single setup in the markets. I want you guys to remember that. So if you had a strategy, you would not even trade this because this does not fall in line with your strategy. But if this did fall in line in your strategy and you was an institutional trader, you was trading supply, you would have entered at that wick right up there and you would have actually executed that trade. Okay. So remember that the most successful, the most successful traders in the world are not the best winners. They are the best risk managers. Your risk profile is going to have everything to do with how well and how long you're going to last inside of the market. Okay, so that's why that 1-to-2, that 1-to-3 risk to reward ratio is really, really, really key, because that's going to keep you in the game, ladies and gentlemen. Most of you guys would have lost this trade. You would have been too fearful to jump back in. You would have never got back in the trade at that wick, and then you would have lost out on that. And look at the great thing. Now, every 20 pips is another 3% of your account. So if you were managing your trade over here, okay, and the market dropped down, let's say you reduced your stop to your entry, you're in a risk-free trade, the market keeps coming, okay, the market keeps coming down. Let's say you removed your stop loss. Let's say you removed your stop loss, and now you're trailing your market. You're now trailing in profits. And you're saying, okay, I'm now in profit. I'm going to put my stop loss in profit, and I'm going to see how, when can I get into this market? Now, remember, early is at the wick. Confirmation traders are the ones that are basically waiting for like that crossover. They're waiting for the candlestick pattern. So if you take a look over here, right, there was no reason to actually enter over there. There was no candlestick pattern for you to enter at this previous zone. So you actually had zero confirmation. You was an early trader with zero confirmation. Is it no wonder it hit the stop loss? No, right? Let's come back over here. Right, we were an early trader. We did the early trade setup at an E1 entry, but we had no confirmation. We looked at previous candles, but we didn't look at the current candles. That's why that stop loss was hit. You come over here, previous early. Now you look over here, look at the confirmation trader. This is how I trade, and you guys know me. I would wait for something like that. I see that nice bearish engulfing. That's telling me that the sellers are now coming in control. I'm going to wait for the cross of my 4, right? You see my 4 McGinley, my 4 MA, right? That's the 7 MA or the 4 McGinley, right? Right over there. I like to see that crossover. Look at how it closed and crossed past that. That's a confirmation right over there. That would have been the reason why I entered the trade. I'm trading off of the high, wick rejection, bearish engulfing, crossover over the 4. Those are confirmations that I'm getting inside of the market. And then in addition, don't forget, there are plenty of different things that I did not do to confirm the trade. Like I didn't look to see if there was any Fibonacci ratios happening over here. Did anybody look to see if the 618 extension was hitting there or there? Did anybody check to look? Remember, we talked about that. Look, Fibonacci extension from high to low. The market was expected to come up there. This was a 113. No, we don't do that. All right, what else? What if I'm looking at, let's say, my trend extensions over here? If I'm doing time, let's not forget time. Not only am I looking for that 618, I'm looking for my 38.2 to my 1618 time zone over here. Look at the 618 time zone right over there. So let me get this box. Where's this box at? I'm looking for my 1618 zone to my 138.2 and my 1618 right over there. That's real confirmation. Let's get rid of the fibs. Let's get rid of the trend-based extensions. Let's get rid of the Fibonacci's. Let's get rid of the EMAs. Let's get rid of all that. And look, in terms of time and price, here goes the real entry. Look at the real entry. Time and price said the market was going to come in the zone and then turn around. That time and price also matched up with our previous wick zones over there. And then look at the drop over there. So now that I took you through like a basic understanding of an entry, and then now I just incorporated Fibonacci's and time analysis. Look at the difference in the execution. So you see, guys, this is where, and again, I know I'm getting deep and I'm expanding wide here, but to be quite honest, guys, look, this is where majority of traders are just going wrong. Like they just, when it really comes down to the nitty gritty of entering in the market, really understanding and learning price action, they just don't have it figured out. They're like children with stick, just swinging the ball, swinging the bat, hoping to hit a home run because they understand baseball. Oh, I understand. I have a bat. I understand you're going to throw a ball and I'm just going to swing and hit it. Okay, what's your position? What's your stance? What's the direction of the weather? Is it a curveball? Is it a fastball? Is it a straight ball? Like, why do you think people that are in Major League Baseball are in Major League Baseball? You think that they're just great at swinging the bat? No, there's a science. They're incorporating all of that into their stance when they hold that bat and they're getting ready to swing. Ladies and gentlemen, okay, they have a tactic. They know what they're doing, right? They have a timing. He's going to release the ball there. I'm going to swing here. Boom, I'm going to knock that out the park. What am I going to do? What are you going to do? Are you just a kid with a stick trying to swing and get every single home run? Do you have good risk to reward? Look at Major League Baseballs. Do you know if you have like, what is it, like a 3.5 batting average, you can make millions of dollars in the MLB? What is a 3.5 batting average? That means that you can hit 3 to 4 out of 10 balls. That's it. Your batting average is 4.0. You are a rock star in MLB. You're a rock star. If you can hit 4 out of 10 balls, and then score a base, you're a rock star. You're a multiple millionaire. Isn't that nuts? Their MLB, their batting average is basically your risk to reward. What is your risk to reward? This is such a perfect analogy. I just made this up, right? By the grace of God. What's your batting average? What is your risk to reward? How are you staying in the market? Now, again, look, let's say you chose to trail the market down. Every 20 pips that market goes, that would have been more profits for you. So let's say that market is coming down. Bingo, bingo, bingo. It ended up hitting that low, which was that other candle zone. So that would have probably been like your best exit over there. So let's say you're over here, you hit the exit. That market went about 96 pips, 95 pips to your thing. Now, if you were trailing this, again, you lost that first one because you didn't know what you're doing. Now you know what you're doing. You traded the wick, you waited for the high, you waited for the candlestick, you looked at your fib extension, you put your time analysis, whatever, you really built out that entry, okay? You did your risk to reward. Let's say you're risking 3, gaining 6, okay, at a 0.16 lot size. From here to here, every 20 pips is another, every 20 pips is another 20% of your account. So on average, that's $32 per 20 pips. So that would have been 32. So since you had 100, that's 20, 40, 60, 80, 100, that's about 5 times. So that's 32, 60, 64, 96, okay? 96, you're gonna add another 30, 120, 120, 129. There you go. So that's 20, 40, boom. And let's add that one more time. 32, 28, boom. Let's carry that over to 28, 30, 60, boom. That would have been $160 earned in that one trade. That would have been, you would have risked 30 and you would have made $160 if you waited for that 100 pip dip right down there. 32 to 160. That's 3, 6, 9, 3, 6, 9, 12, 15. That's a 15% account growth in your accounts. See that? Boom. Right over there. All right. Anyway, I know I'm getting so deep on this, and there's so much more that I wanted to train you guys on when it comes to composing a trade idea inside of the market. But from there, again, guys, remember, you could lower your time frame, you can have a multi-time frame entry outlook, and then you can do so much. And I just wish I can be here for just, I mean, hours and hours and hours and hours and hours, you know, doing this. Again, look, E2 would be the break in the close of that 1400. Let's see. Okay. Let's do that on like a 4-hour. Let's look for a break in the close. More consolidation. Now, again, while all this consolidation is happening, remember, all this is doing is that if you're now looking to enter the market, this is giving you more confirmation to enter based on that larger analysis. Remember, that larger analysis was you're looking for that reversal. You now have a huge consolidation zone. The market is now making series of lower highs and lower lows inside of the market, strengthening your idea if the market is coming down. You keep going, you keep going, you keep going, right? Oof, that market was, this was trapping up so many traders in this area right over there, like ridiculous. That break and close right there could have caught anybody if you're not trading correctly. Boom, the market was ready. The market goes. Market is out. Market is gone. So it gave you a very small break and close. It pulled down. 4-hour pulled back up. All right, I could sit here, but I don't want to be here for another hour just breaking all this down. Okay. But boom, market came, break and close a little bit low, pulled back in, ended up coming down. Now, here's one thing that I wanted to train you guys on. I don't trade the breakout so much. I like to do E1, pull back to the equal high with the confirmation. And I like to do E3, which is a retest of a previous zone. Now, one thing that I did not train you guys on in a previous lesson, which is something that I want to give you guys now as a bonus, is also understanding volume balance in the market. Okay. So one thing that I want to share with you guys right here real quick, let's delete this zone. I want to show you something that's extremely, extremely, extremely important over here. Okay. Whenever you're looking for the market, right? Whenever you're looking for the market to pull back to a particular area, right? I'm going to get rid of all this. I want you guys to see this clearly. Okay. Whenever you're looking for the market to pull back, like if you're looking for an E3, okay, and you're looking for the market to pull back to a certain area, I want you guys to remember that all candles have to be filled, right? All balances, just like whenever you're trading, you know, the Fibonacci's, right? I'm going to give you guys an example, right? Whenever you're trading the Fibonacci, the market always looks to pull back, right? 1/3 to 2/3, it can go higher, but 1/3 to 2/3 of the market before it keeps going. And the reason why it does that is because there is an equilibrium in the market, right? The equilibrium must be met inside of the market. Now, this equilibrium also exists for candles, and many, many people do not know this. So I want to let you guys know about imbalances in candles in the market. And this is going to help you with your E3 entries anytime you're looking for the market to do a break and you're looking for the market to do a retest. Okay, and this is going to be exceptional for you. So let's take a look over here. Okay, we're going to take a look right over here. Now, if we look at this red candle, look at the red candle here. Okay, let me lock this up. Let's take a look at this red candle right over here. Okay, now if you look at that red candle, you'll see that on the left side, the green candle is there. And if you see the wick is right over there, right? Actually, I need, let me not do this. I need you guys to see this. Just look at it, okay? Just look at it, okay? You'll see here, the whole entire candle has to be covered on both sides by the body or by the wick. If it is not covered fully on both sides by the body or the wick, that is known as an imbalance in the market. And the market will always look to fill out that imbalance. So if you see here, this market closed here, and you see this wick close all the way over there. So that whole entire candle is covered. You look at this candle, the candle closed and candle opened. You see the wick is right below that. You see the wick here is above this. This entire candle is covered. If you look at this candle, the wick comes right down here, and this wick comes all the way up here. The entire candle, this candle is covered by the previous one. If you look at this one, the wick came down here, and this wick came up here. This entire candle is covered. So all these candles are balanced. Now, as we look down, you're going to start to notice imbalances. Now, if you take a look over here, you're going to see that when this candle opened, this wick came right here. And you're going to see that this wick came right there. So take a look at that. There's no wick on this side. There's no wick or candle on this side. All right, so let's draw this out. Okay, let's draw this out. At some point or another, at one point or another, this area is going to get filled. This imbalance has to get filled at the very least, in this area. This imbalance has to get filled. So now we know, okay, that's a potential area where the market can pull back to. This is filled. We can see that this wick is here. That's filled. All these candles are filled. All these candles are filled. Filled, boom. The market starts dropping. Now I want to show you guys something, okay? This right here was the breakout, right? You guys seen the low point over here? This is when the market actually broke out and came low, right? Look at our line. We're going to look for the market to break that low, right? Break the low somewhere over here, retest somewhere, and keep coming back down, okay? Now, wow, look, right here. I want you guys to look at that wick. See how that wick came right back into that area? I'm actually surprised that entire zone was not filled before the market ended up dropping off. But if you can see this right over here, there is an imbalance inside of this candle. Look at how the wick came up to fill that imbalance inside of that area. And that is extremely, extremely, extremely important to understand anytime that you're going to be trading an E3 or a pullback. So don't forget, whenever you're going to trade the E3, when the market breaks from high to low, you take your fibs from high to low. You're going to be looking for 1/3 to 2/3 of that area to come in. And if you also want to do time, whenever you're doing this, you want to make sure that the time is between the 38.2 to the 61.8, right? Which means that this area right over here would have been your reversal zone for that E3 in terms of time and price. And you also see that there's a huge imbalance right over there. So if you just keep this true, if you keep this area true, right over here, there goes your entry points inside of the market. Where was the 618? Okay. There goes the 618 right over there. Boom. Okay. If you kept that area true, look at how you could have came in and demolished that entry point. That's an early trader. Confirmation traders, again, wait for the candles. Right over there, you see the candlesticks like that. Bearish engulfing, sellers are in control. They like to see the crossover of certain EMAs. Look, see that 7 MA or that 4 McGinley crossover happened right over there. So it's actually also bouncing under our 50 right over there. So lots of different ways to confirm that. And then bingo, look at how that market ended up dropping off right over there. Okay, leaving you with another huge imbalance. So you can expect the market at one point or another to fill out that imbalance. Okay, you expect the market at one point or another to fill out that imbalance. And, we can go on and we actually, if you guys remember, as this is playing, I believe it was volume 1 or volume 2, we actually called this out right here in terms of time and price. We called out that entire bullish run right over there as well. And, you know, this market may keep dropping, but let's exit that out. Okay. But you'll see here, there's a huge imbalance. So at one point or another, the market's going to come up to fill that imbalance area where you can look for more entries. Okay. Anyway, let's get rid of this. Let's get rid of this. All of this stuff over here. All right. So just additional little tips and tricks for you guys inside of the market. And again, I can be here for days because I just wanted to continue to really dive deep, but I can't be on here for 3 hours. But again, look, if you're in here, boom, the market turns over. What happens when the market turns over, guys? The market turns over. Now you're looking for the next potential entry. The market structure reverse, high, high, break of the low, pulled low, retest, pullback. You have a previous pullback. You go high to low, 1 to 3 right over there. Your time and price, boom. You can take that down. You can trade that down. You know, is that market, trading below the trend? Are you, touching any EMAs or McGinley's, so on, blase, blase, blah, so on and so forth, right? So at this point, ladies and gentlemen, we're gonna get ready to wrap that. And there was so much I wanted to show you. I even wanted to show you stuff like on USD CAD and everything, but I forgot how long it would take to really peer into the market to understand these different type of things. Okay. So guys, look, just coming back over here to wrap up this portion of composing a trade idea. I hope I have done a stupendous job of really bringing you through and walking you through composing a trade idea. So remember, there exists not a one size shoe that fits all. All right. In order for you to enter the market based on price action, it's going to be a combination of your market outlook and your entry outlook. Okay. And really just waiting for that sweet spot in the market for you to enter. And when you find that sweet spot, that area of high probability for you to enter, you make sure that you trade with proper risk management, that equity growth proportion. Okay. Proper risk management, risk per trade, risk to reward, things like that. So that way you can survive the market, the longevity of the market. Now, don't leave just yet, because for those of you guys that have completed this, I'm going to show you guys how to get your certificate of completion. Okay. How to do that. Now, from here, we're going to continue to dive in, and I want to help you guys expand your education. All righty. So I want you guys to remember that this entire boot camp is designed to help you read naked price action in the market, really understanding the price reading and the different things that you can do. Now, you're going to have multiple. Let me come over here. Okay, you're going to have multiple strategies that you're going to be able to learn inside of the market. And what these strategies are going to do is these strategies are going to carve out parts of the market. Okay, these strategies are going to carve out parts of the market that you're going to only look to trade. That's it. Parts of the market that you're only going to look to trade. Right? As an example, let me come over to the testing server. Right? So I'm going to show you what a strategy would look like. Now, there are dozens of strategies. I'm going to show you all of the strategies, and I'm going to show you all of the educators. But let me give you guys a really good example over here. Okay? So let's say I'm over here. I'll do like a 4 hour. Give me one. Let's bring this over here. Let's load that up. Let's load chart layout. Let's do pro. So there's one. Okay. Oh, I'm not sure why the testing server is down. All righty. So for whatever reason, that testing server is down. That's not good. All righty. Well, let's come over over here. Okay. Let's remove all these drawing tools. Okay. And whenever you have a custom setting, like a custom strategy, what the custom strategy would do is the custom strategy will give you areas where you can enter based on the settings. Like as an example, I'm not looking to trade every single high and low and turn in the market. I like to trade market reversals and trending markets. So for me, when I have a strategy, my strategy will tell me, okay, well, when the market structure reverses over here, let me give you an example. Once the market structure ends up reversing and it's breaking, these previous highs inside of the market, and now we're in an uptrend, I like to wait for the market to pull back. Okay, and when the market does pull back to our dynamic trend, when I get a nice rate and change letting me know that the market's going to go bullish, then from there, I like to trade and I like to buy up in the market. And you see here, my strategy will give me one trade right over there. My strategy gives me another trade entry right over there. My strategy gives me another trade entry right over there. Okay, all going up. Now what's happening over here? Market's high, market is low right down here, right? I don't want to trade that. I don't want to trade that. The market's turning around. Now I'm going to wait for the market to turn back around and to start giving me sells inside of the market, right? Like I like to wait for the market to turn around, be under the trend, and then under the trend, as we can see here, look, boom, see the black bar? There goes a sell. Boom, see under the black bar, that's another entry. Under the black bar, there goes another entry. That's all a part of my strategy and my scanner inside of the market. So remember that a strategy will help you find your edge. Finding your edge means that it's going to cut out all of the stuff that's in the market that does not pertain to how you create a trade idea. Okay? And when you have found that strategy and you have found that edge, now that you know the entire world of trading and the entire world and all of the markets, you can now use that strategy and you see it again and 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 again. And you only trade that strategy with proper risk to reward. That's how you are going to survive the markets. So expanding your education. Remember, IM Mastery Academy offers a wide range of education, advanced price concept techniques, and unique strategies to further your education, all tucked away in various educator and strategy channels. So I'm going to walk you through Go Live. I want to introduce you to some of the other people where you can check them out. And I want you guys to remember that these are highly sought after markets. So let me tell you guys about some markets that you do have the ability to trade in, right? So first off, you have regular fiat currencies. Everybody loves trading fiat currencies and Forex. They say that Forex is the king of everything. Why? Because it gives you so many different pairs to trade. And you can either trade Forex on a regular, like a Forex trader, or you can scalp Forex and you could be like a high frequency trader, like the boys in the HFX package. They like to do high frequency trading. So they know Forex very, very well. They train on Forex, right? But they specialize in smaller time frames where they're looking to just scalp the market. They do everything based on time, right? It's a different style of trading, but it does have to do with Forex. Or if you're a typical Forex trader, you have all the majors and all the minors giving you a lot of different trading options every single day. And that's what makes it so exciting. The ability to get into one trade, and if you're at the right place at the right time and you catch that trade, guys, you can the equity growth on your account in one trade can be absolutely marvelous. What do I mean? I mean that this is why I love Forex trading. So let me just say this here. If I know what I'm doing and I'm catching these amazing reversals here in the market, all I need to do is get into the market one time here. And as long as this market is dropping this entire time, that one entry is going to constantly and continuously bring me money in my account, whether I'm sleeping, Whether I'm on the chart, whether I'm off the chart, whether I'm working, whether I'm shopping, it does not matter. And I can always manage it and look at it from my phone. So that's why there's huge advantages in being in the FX market, because once you know what you're doing, bingo, you're getting into huge swings, days and days and days and days of profit, watching your account grow. And with proper risk reward, if you're risking 3% of your account and 20, 40 pips is 4% of it is 6%. Imagine the market dropping 300%. You could double, triple your account in one trade, right? That's the mathematics. That's how it works. So that's why Forex is so exciting. You get to do that in all major and minor pairs. Now you also get to trade metals. So there are gold, silver, and platinum. So once you're attuned with regular currency pairs and you want to start getting into things that move a little faster, that have a little bit more money into them, you can start trading metals, gold, silver, and platinum. Now gold is traded often, very, very popular. So gold is something that you're going to see often. Then you could also get into commodities. Now metal is considered a commodity, but because it's a metal, I just labeled it as metal. And now you could also get into other popular commodities that move the market as well. So once you're trading majors and minors and you're getting into gold, silver, platinum, you could also get into crude oil, right? And natural gas. So crude oil and natural gas is something that is traded a lot, right? There is money on the table for that. From there, you could also choose to get into exotic currencies, right? You can get into exotic currencies. All right, and the exotic currencies, you have the Turkish lira, the ZAR, the Mexican peso. There are so many different exotic currencies that you can trade. And now, while exotic currencies can be a little bit more expensive to trade, meaning that, you know, the spreads can be a little bit larger on them, you know, there is a great reward for exotic currencies as well, because they move faster. They move a lot faster, and there tends to be a little bit of less manipulation. So do your research on exotic currencies, and I'm going to be trading exotic currencies on the release of my new app. Now, from there, you can also get into indices. Indices is basically like trading stocks. You know, you can trade basically like stocks, but in the Forex market. So you don't actually have to own and hold the stock to make money. You can just trade the stock in a sense. So, and those are called indices, right? Some very popular indices are the US 30, which is the top US 30 stock, the NAS 100, the SPX 500, the UK top 100, the German top 30, the JPN 225 is a very, very good one. It's the Japanese 225 that they have over here. These are some very, very good indices that people like to trade because they move very fast. Now, something like this requires a large amount of capital and equity in your account to trade, but they do offer some very, very good trades in the market, like US 30, NAS 100. Like some of these markets can go for 1, 2, 3, 4, 5,000 pips, you know, when you're executing them. And that's exciting. I've seen people do amazing things with these markets, but I've also seen a lot of people blow their money in these markets because they just weren't ready. Their mindset wasn't ready. Their emotion wasn't ready. Their trading skills was not ready. So remember, these are markets that you want to graduate to. Okay, but once you have worked your way up and you're going through these currencies and you're going through this list, you're then going to get to the point where, you know, the world is just your playground, the market. You could pull up any chart. I'm trading them. Give it to me. And then last but not least is also cryptos. And cryptos is available in our DCX package. All right, cryptos, you can trade major cryptocurrencies like Bitcoin, XRP, Ethereum, Litecoin, and then there are lots of different type of crypto pairs that you can trade as well, even though these are some of the major crypto pairs that people like to trade. So if you're interested in DCX, but you want to really, you know, you want to master the skill set of trading, feel free to purchase the Swipe Coin add-on. You know, there's some great crypto traders like Crypto Picasso and also Nick Gomez and them, and then they'll send you trade ideas on cryptocurrency pairs like Bitcoin and XRP. So as you're, trading the regular Forex pairs, you're learning, you're mastering, you're working your way through these. You could also capitalize on a couple of crypto trades as well. The company has so much amazing things to offer. Okay, now let me show you guys just a couple of the different people that you can go to. And I want to show you guys this. So let's go on over to Go Live and let's take a look at Go Live. So if you're completely brand new and your mentor, your upline has not really brought you through Go Live, you don't understand, let me just quickly give you a walkthrough. Okay, as you go down, there's going to be different channels, and these channels are going to be available based on what package you have. So if you have the FRX package with the Forex traders, you'll have the FRX education. If you're an HFX trader, you'll have the HFX education. If you're a DCX trader, you'll have the DCX education. Okay, so right now we're going to focus on the FRX education. So as you come on down, you're going to notice that there are multiple different strategies that you can choose from over here as well. Now, each of these strategies have different master educators, and each of the master educators train on a particular strategy, which is usually accompanied by some type of software. And that software basically aids